I'm Charlotte McLeod with investingnews.com, and here today with me is John Hathaway, Managing Partner at Sprott and Senior Portfolio Manager at Sprott Asset Management USA. Thank you so much for joining me. Great to have you here.
A pleasure. Thanks, Charlotte.
Really excited to be speaking with you. And for some context, I had a friend send me your report on the investment case for gold. And when I read it, I thought it would be great to go through that for our audience, because I know we have a lot of people who are seeing the gold price historically high, and they're wondering what's going on with the gold stocks. So we're going to get into that today. But where I thought we could start with is setting the stage historically and looking back and seeing if we've ever seen a disconnect like this in the past.
Not to my knowledge, and I guess I've been doing this for 25 years. So this is the greatest disconnect I've ever seen.
Okay, so all the more reason to be talking about that. And I think we should get into what are the main reasons for this disconnect. Everybody knows that it's there. They can see it happening. What are the reasons that we've seen this build up? Because as I understand, compared to the previous bull market, gold miners have been cleaning up their balance sheets. They've improved profitability. So what's the reasons?
To me, one of the biggest culprits or explanations is passive investing. And we've seen a lot about this lately. I believe there was a very good piece in the Financial Times written by John Authors, and it's in the last week or so people can look it up, basically saying that that passive investing, which really dominates the markets today, doesn't favor smaller sectors, and the gold mining sector is, the market cap is about the same as MasterCard or Home Depot. So it's tiny, but in today's markets. So that's one factor. And another factor that's kind of an offshoot of the same point is that in 2004, the gold ETF was launched by the World Gold Council, and now since then there have been quite a few more. So before that, it was really difficult for equity investors to position the macro thesis behind gold, which we can probably talk about at some point, without owning gold stocks. But gradually, over the last, call it 20 years, it's been increasingly easy just to buy GLD or the equivalent, of which there are many. And so it took a lot of the thinking out of the equation. And therefore, I think it's fair to say that the gold-backed ETFs have cannibalized demand for gold mining equities. So those would be two of the biggest reasons I can think of.
Yeah, okay, that's a really interesting point that you mentioned with the ETFs and the rise of passive investing. The other point I was going to bring up, so we've got that aspect, and then aside from that, we've got so many other things, options that people have today for investing. They can look at crypto, they can look at other trendy investments. I'm wondering if you think the gold miners have a responsibility or should be looking at ways that they can make themselves more interesting to investors, or your thoughts there?
Okay, well, that bundles up a lot of questions. You mentioned crypto, and certainly that has taken some of the air out of the room for gold mining stocks. And certainly, and that's especially true for the generation. Let's call a dividing line somewhere in the 40s. So people under 40 are going to think seriously about crypto, and so that's another factor that you could mention. What could the gold miners do to make themselves more attractive? Frankly, they're already so attractive. I don't think they have to do a whole lot. I do believe, and this is kind of a soapbox I've been on lately, is they should be buying back stock because they were so ridiculously cheap. There's a better return on capital from share buybacks than there is on investing in a big new mine. And in a way, that's saying that the industry should be, or at least the market is saying, and they should, management should think seriously about semi-liquidation. Why build a $1 billion new mine when it takes up a lot of capital, takes on a lot of risk for shareholders, whereas buying back equity that's undervalued provides a sure return to investors and is a way of taking advantage of the fact that nobody cares. And I think there's a lot more return from doing that than there is for necessarily building a big new mining project. I think that would be a controversial view to many of the mining managements, but I do believe that that should be strongly considered as opposed to taking a lot of capital risk on. These companies are penalized for growing. They can only grow by, or they can only sustain themselves by investing heavily in new mining assets, and the returns on a new mine really don't become apparent for probably 5 years, maybe 10 years. So anyway, that is my thought. The best thing I think the mining industry could do would be to take advantage of the heavy discounts that they're being valued at and enhance shareholder returns by doing that.
I was going to ask, if you see any companies that might be looking to do this, but then you mentioned it's controversial. So I guess perhaps not at this point.
Well, there's some that are doing it, but they're doing it kind of. I guess the best way to put it, it's not enthusiastically. They're doing it because people like me and other portfolio managers, analysts in the gold mining space tell them that it's a good idea. So they kind of go along with it, but not wholeheartedly. And that's fine. I mean, I think as time passes, and should these stocks remain as ridiculously inexpensive as they are, I mean, you look at other industries that are out of favor. You could talk about base metals mining. You could talk about steel. You could talk about oil and gas. They're all engaged in shareholder in share buybacks and try to create shareholder value that way. I think the mining industry is behind the curve on that particular aspect.
Okay, really, really interesting to go over that. And I want to go back now to that disconnect between gold price and the gold stocks. And when I ask people who I've interviewed in the past, what makes the gold stocks catch up, a lot of the time I am told, the gold price is historically high, but we need to see it move a little bit higher, and maybe that's when the stocks start moving. But you had written in your note that perhaps they could catch up just if we see a reversion to mean. So I thought that was quite an interesting idea, and I wondered if you could talk about that.
Sure. Well, you brought up one thing, and that is a higher gold price. But we have a higher gold price, and I can't remember how many days we've closed over the magic $2,000 number, but there's probably been a couple of months worth, and it hasn't done a darn thing to generate interest in mining stocks. Is it a little higher? Well, yeah, I think it is higher. I think, is it 2,100? Is it 2,500? Somewhere along the way, higher gold prices will generate interest in gold mining stocks because they're leveraged to the gold price. And no need to go into it in any depth. But so I think that is that's the conundrum. We have what we've always wished for as investors in gold mining. One of my partners way back when we started the gold fund 25 years ago said, the only reason anybody should want to own a gold stock is because they expect the gold price to go up. And he was right until now, when that hasn't been right. So how much higher does the gold price need to go? I don't know the answer to it. But at some point, higher gold price will lead to such incredible cash flow and profitability that even this tiny little space will catch somebody's eye. I note recently that Stanley Druckenmiller, the legendary investor, has started to sell his Magnificent Seven stocks, and he's starting to buy big cap names like Newmont and Barrick. And I'd like to think he's right. He's usually been right. So my guess is that there are some value investors out there. There still are active investors. There's still active investors, even though passive investing dominates the markets. But because the space is so small, and because collectively the market cap is tiny relative to the capital flows in today's markets, it doesn't take a whole lot of change to generate potentially outsized returns. So, I'm sitting here expecting that to happen. I've been waiting longer than I would have thought, but I still think I'm on the right track here.
I want to spend a little bit of time looking at the gold price this coming year. So I think it's the consensus definitely is we're going higher. We don't necessarily know when or how much in what period of time, but the trajectory looks higher. So hoping that we can talk just a little bit about gold in 2024 and the drivers you see. Of course, everyone is watching the Fed and the added context. There's an election year, we have geopolitical things, we have central bank buying going on. So just a quick look at your thoughts on gold drivers this year.
Well, certainly you bring up the Fed, and it has been this narrative of higher for longer interest rates has been a real headwind for the gold price. But it hasn't really hurt the gold price. In fact, we've had higher interest rates for a long time. And despite that, the gold price is trading at record levels. And what's interesting is that it has happened without participation by investors in Western capital markets. I'd say the U.S. and Europe to be the ones, the main ones. So why has the gold price gone up? It's gone up because central bank buying is taking place at record levels. And then I guess the question is, why are central banks buying when nobody else is? At least nobody in the markets that we are familiar with. And the reason they're doing it is because they are diversifying away from the U.S. dollar and settling trade balances in gold, not in U.S. treasuries. I read recently that 20% of oil is now traded away from the U.S. dollar. So think of it. We have gold trading at record prices, and the level of interest in Western capital markets is absolutely negative. It's zero. Gold-backed ETFs have lost assets for the last 2 years, and yet the gold price has gone up. And just imagine what could happen if people in our part of the world decided, well, they should probably have a bigger exposure to gold. Again, hard to say when that's going to happen, but remember that when gold previously peaked 10 years ago, Western investors were heavy buyers of ETFs. And that helped propel gold to the 10-year peak or the previous peak 10 years ago. So should that happen again, and we could we could guess all day as to why it would happen, but I'd be happy to supply some thoughts. It wouldn't be crazy to think of gold trading in a sustained range north of $2,500, $2,500 to $3,000, if people in our part of the world decided they wanted to increase their exposure to the metal. And should that happen, I'll just, you don't need to guess too hard to see what would happen to gold mining stocks.
Yes, and what I wanted to ask you about gold mining stocks. So eventually they're going to move. I think that's probably a given at this point. How do you think that will play out? Because usually we hear that when stocks start to move, we see the larger ones move first and then on down to the bottom of the chain. So, but it feels like now we have this pent up, everything is waiting to move. So I wondered if you thought it might play out in a different way.
Sure. I mean, I think that's a good point. The big cap names, Barrick, Newmont in particular, have been dogs, and they've been dogs for a couple of reasons. And they dominate GDX, the Van Eck Gold Miners ETF. And so that creates a negative impression for the entire space. But if you look down deep into the components of GDX, and then look at companies that aren't even in the ETF, smaller companies, mid cap and smaller, they're actually holding up pretty well. They're doing better than the headline names, and I think that is a sign of how inexpensive they are, and maybe they're better managed. Maybe there's more ownership by management and alignment with shareholders than you see with the big names, the two of which I've mentioned. There are others as well. So I think that the ray of sunlight that I would point to is the relative performance, the actually good relative performance of mid to smaller cap gold mining stocks, particularly those that are located in countries that have a rule of law. And I think that, in today's world, that eliminates a lot of the surface of the globe. But companies in the U.S., Canada, and Australia are important in the gold mining space, and that's where we're investing. We're not investing as much as we used to in either Latin America or Africa.
Okay, so that's a little bit on jurisdiction in terms of what you're looking at. Can you add any other criteria that you are focusing on right now when it comes to gold stocks?
Well, we pay a lot of attention to something I've just mentioned earlier, which is management ownership of shares and alignment with shareholders. And, that doesn't really exist in the large cap names as much as it does in the mid to smaller cap space. So that's a really important aspect of what we look at. And you mentioned jurisdiction. That's a critical component. There are some great mines in Africa and South America and Asia. But you have to be super picky about where you're investing in those areas, just because there are so many bad headlines coming out of, I don't even need to name the countries. But the rule of law is a vanishing concept in many parts of the world. Sad to say, but true. And therefore, we think when investors return to this space, they're going to appreciate the difference between one jurisdiction and another. And so I think the kinds of things that we own will trade at significant premiums to the rest of the space. Right now, nobody cares, so everything is kind of muddled together. But when generalist investors start picking over the names that are inexpensive and attractive, they're going to end up focusing on jurisdiction as one of the major criteria.
I want to hopefully touch on the M&A angle as well, because I think you mentioned earlier, the large miners, their reserves are depleted. There's been underinvestment in exploration. And in your report on the investment case for gold stocks, you had an interesting point talking about Marathon Gold, which ultimately was bought by Caliber Mining. But I think you'd mentioned there was something like almost 20 entities that were interested. So it feels, again, like this is an environment where we might see M&A. I wondered if you could give some flavor on what we might see, what level we might see it at, and how much.
Right. That's a very important thing to talk about. So we've seen two kinds of mergers. One is mergers of equals, where there's really no value creation, even though the participants would say otherwise. They're done at no premium, and there really aren't any synergies. There always, of course, are some, but they're not meaningful in terms of value creation. On the other hand, the one you just mentioned, Caliber buying Marathon, is an example of a really smart merger. There are others that we could talk about of the same kind, but there is a premium involved, and there is a case to be made for a re-rate on a bunch of scores. On that particular example, we have a company that's generating a lot of cash flow based in Nicaragua. It's managed by a team from Australia. And they bought Marathon, which was poorly managed in terms of capital raising, but located in Canada, Newfoundland, a terrific asset that is in the final stages of construction and will be producing within, I think, another year. And so you have a company that sort of rated at 3 or 4 times cash flow. I'm sort of making this up, but just to make the example, because I can't recall the exact number off the top of my head, that should be trading at least 50% or twice that kind of valuation once the jurisdictional advantage of having a large component of your cash flow coming out of Canada, and then I think that that tends to diffuse the fact that although they have very good mining operations in Nicaragua, I think you blend the two, and investors can be more reassured of the continuity of the business. So that's long-winded answer, but there are examples of that, other examples taking place, and they just don't make headlines because the companies involved are small. So that's the kind of thing I'm thinking of. They are value creating, and I think we will see more of that. One last point on this, and that is that it's instead of starting from scratch to build a new mine, which involves huge capital risk, there's a huge discount for buying existing operations in the market. And we figure it's as much as 30 to 50% versus starting from scratch and building a new mine. So again, the astute managers in the space, and there are many of them, are seeing this opportunity and taking advantage of it. And of course, we applaud that.
Okay, thank you for going through that. I think we'll wrap it up here. This has been a really good run through gold and gold stocks, and I do encourage everyone to go out and actually read the report that you put together. I'll have it linked in the video description. But just before I let you go, I'll put it back to you and ask if there are any final top topics that you would leave investors with.
Well, we didn't talk about what could happen to make people think about this space. One thing, of course, is a higher gold price. But what would that be? I think it would be a reversion to mean, not just in the gold mining space, but a reversion to mean in the external markets. We all know that the stock market basically has been driven by 7 names, huge concentration, huge, again, if you're a contrarian, it's an easy trade to make. Sell the Mag 7 like Druckenmiller just did, and look for something that's completely discounted. It's not just the gold mining space. You could talk about oil and gas. You could talk about some cyclical names. So I think that's one thing. The other is, I think there is some potential in the world of banking. We've been reading about how commercial real estate is in trouble. It's not just in the U.S., it's in Europe as well. So there are potential issues in the banking system which nobody is paying attention to. So I think that's another thing. So in a way, you could have a combination of the dot-com crash in 2001, and the global financial crisis in 2007-8, combining to turn consensus investment banking upside down. And, that's the sort of thing that would lead investors to look for diversification, which gold represents. And again, we've noted that nobody in our part of the world is there. So a small trickle of interest driven by, I've just suggested 2 possibilities for things to change. I believe that that's the scenario I would point to for the gold mining industry and gold itself to come back into favor.
Okay, thank you for adding that on to tie everything together. I think that leaves us in a good position to wrap it up. So thank you so much for coming on to talk.
Thanks, Charlotte. Appreciate it.
Of course. And once again, I'm Charlotte McLeod with investees.com, and this is John Hathaway. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.